updates. The IRS had given some guidance, so we'll let the room fill up here, let all the channels turn on, and then we're going to hop into our video today. So just give a few minutes here, about 15, 20 seconds. We'll give actually not too long. All right, cool. Yeah, so just before we hop into everything, talk about the IRS guidance that came out with they came with a website, talk about marijuana related businesses and tax guidance on that essentially. So we're going to pull back and, talk about one of the aspects that they were giving guidance on that is probably creating a little bit of confusion for some people. So before we get started, I need to let you know that the information contained in this presentation is meant for guidance purposes only and not meant as professional, legal, or tax advice. And further, it does not give any personalized legal, tax, investment, or any business advice in general. So let's just hop in and give some color and context to what we're going to talk about. It should be a 10 to 15 minute video, nothing too laborious, but kind of opening your eyes to some of the, I'll say, misinformation or just undiscussed information out there. So a few weeks ago, you may have seen news outlets, even us, reporting that the IRS put up a web page or a website giving guidance for cannabis related businesses. Now, one interesting question was around IRC 280E. And deductions for cannabis businesses. We should be very well aware of what 280E is, but from the frequently asked questions page on the IRS guidance for marijuana-related businesses, there was a section that kind of created a stir. And I'll just read it here and we'll jump into it and pull it apart. So what it says here, Section 280E does not, however, prohibit a participant in the marijuana industry from reducing its gross receipts by its properly calculated cost of goods sold to determine its gross income. The Internal Revenue Service takes the position that Section 280E affected taxpayers must calculate their cost of goods sold pursuant to IRC Section 471 and the associated Treasury regulations. Now, that last sentence there about 471, this made people think that the teeth were taken out of 280E, and that if your cannabis business makes less than $25 million, you can just treat all costs as inventoriable costs, including your typically non-deductible costs, your SG&A costs, things like sales and marketing and computers and things that you can't really write off nowadays. So it was very ambiguous in that sentence they wrote there. They wrote Section 471, the IRS did. So that's what we're going to talk about today. So what is Section 471 of the tax code? Well, 471 is a main section of the tax code that deals with inventories and inventoriable costs. And it has a lot of parts to it. So you have 471C, that's what we're going to unpack today. And then you have 471.3, 471.11. They're all part of it. So it's all connected, which kind of makes this discussion confusing to some people that led them to believe that the IRS website was clarifying the new Tax Cuts and Jobs Act, which is the Trump tax law, tax loophole, which is actually a tax law. So what is this tax loophole or this tax law? Well, first, I want to start off by saying there's no such thing as loopholes. These are laws that are accessible by all tax-paying people or tax-paying businesses. So these are laws. You just have to, know somebody who knows the laws to then implement them for you and then allow you to take advantage of these laws, right? If you don't know about them or don't know what they are, then you're probably going to be in a worse off position compared to your competition. But essentially, what the Tax Cuts and Jobs Act allowed or put into the thing that says the 471C got updated, in 2018. And essentially, it made an update whereby an entity with gross receipts less than $25 million can choose its method of keeping their books. So this seems like it would apply to nearly most cannabis businesses because most of them make under $25 million a year. Now, note that this change in accounting method, it needs to be approved depending on what you change, right? If you go from cash accounting to accrual-based accounting, you're going to need to get that change in accounting method approved. Now, they made that abundantly clear. They being the IRS, they made it very, very clear that if you're going to change your accounting method, that you need to have this approved. And they talked about this specifically for cannabis businesses in the Richmond Patient Group case. So I'll link to that after the live stream is done, or you can search our YouTube channel for the Richmond Patients Group case that came out this year, I believe in April or something like that. But at any rate, That's not really what the meat we're talking about here. What we're really talking about here is that the tax play. Let's talk about the tax play for this, right? The tax play is that you would then, under this whole $25 million, you can change your accounting method, that you would treat all of your costs as inventoriable costs, even costs that are not ordinarily inventoriable costs, such as selling costs and general and administrative costs. Now, essentially, you could, in theory, record all those costs into inventory and then expense them and flush them into cost of goods sold. Now, why is this law not a bypass of 280E, and that you should not try to use this as a cannabis business? So when our team read this new IRS page, we combed through it. We had a team meeting, all hands meeting. We read their mention of 471 as 471.3 and 471.11, not 471C, for the following reasons we thought this, okay? Under 471C, as I explained earlier in this video, you can choose your method of keeping your books. Now, so you could theoretically say that all of your sales and marketing expenses are going to be inventoriable costs based on your method of keeping your books. Therefore, you could just push them down into COGS. However, the IRS page, the new one that went up on September 11th, it says this specifically. Accordingly, a marijuana dispensary may not deduct, for example, advertising or selling expenses. It may, however, reduce its gross receipts by its cost of goods sold as calculated pursuant to the Internal Revenue Code, Section 471. Now, so let's build on that last sentence there. The new IRS page for cannabis businesses or marijuana businesses specifically links to Chief Counsel advice dated 1/23/2015, which goes into detail on costing of inventories and cost of goods sold. Now, the linked advice specifically states that 1-471-3 and 1-471-11 is the way to go about inventory costing and cost of goods sold. And in addition, that linked advice that we talked about, the Chief Counsel advice from January 23rd, 2015, it states that 263A, which is also known as UNICAP, which is more generous than 1-471 when it comes to the treatment of inventoriable costs, they say in that same advice there that it's not applicable to cannabis-based businesses or marijuana-related businesses since it was enacted after the 280E law was passed. So, knowing that point right there, that last sentence, we would assume, in that last sentence, I'm going to say it again, that since 263A was enacted after 280E, it is not applicable to cannabis-based businesses. So again, let's build on that. We would assume that same logic, that the IRS would take the same position on this Trump tax law or the Tax Cuts and Jobs Act of 2018 and 471C, and indicate that since 471C was passed after 280E, it does not pertain to cannabis businesses and they cannot take advantage of that. So to tie all of this up here, there is no new tax loophole to bypass 280E. And anyone that interprets this new IRS webpage as such is putting themselves, their co-founders, at incredibly high risk. And if you're a tax professional and you're going to implement this for your clients, you're probably putting your clients at an incredibly high risk that's unnecessary. So just tying it up, 471C came after 280E, and since UNICAP, which is 263A, was taken away from cannabis businesses because it was created after 280E, it's likely that 471C will not be accessible by cannabis-based businesses. 471, just that tax code, it's a very large tax code with many facets, and the IRS page gave enough ambiguity for speculation that the Tax Cuts and Jobs Act 471C tax law could potentially be used. So it's up to you to make your decision on that. We're just trying to clear something up because, you know, these news outlets, oh, there's new tax code, but they don't tell you what the hell that actually means. So I hope that this video has broken that down for you, right? There's no additional room for cannabis businesses in this new IRS page. It's just informational and clarifying their positions already. There's nothing new to be, found in this, right? We've made a video on essentially everything that's in that IRS webpage before it even went up. So this is just an informational page. So show this video to your CPA and see if they say something different. If you're a CPA or an EA or a tax preparer, watch this and let me know, what do you think about it, right? If you as a cannabis business show this to your CPA and they put your cannabis business at risk by taking all these unallowable deductions because of this 471C tax loophole or opportunity, in their loose interpretation of some website put up by the IRS, then, they're really putting you at a high risk, and you should be ready for what comes during an audit. Everyone has their own risk tolerance. And if you want to be very aggressive with your taxes, you have the option to just deduct everything. And this is all a choice. There's laws and you can break laws. You can willingly break the laws. There's going to be ramifications for that. So essentially, someone's going to have to be the first to test 471C for cannabis businesses. But I, in our group, would not recommend this action, this risky action, to any of our clients. This is not something that we're going to recommend to any of our clients, right? You work very hard to get your business open with licensing and build out and truing up your systems, only to get caught in some long tax battle over some expenses, just because you want to be a superhero and be a groundbreaking person in the tax space. It just seems like not a good risk reward balance. So if you have any questions about cannabis taxes or cannabis related businesses and the taxes or anything financially related to your cannabis business, please reach out to us. Visit our website at greengrowcpas.com. Click the Get Started button in the top right corner, fill out the form, schedule some time to chat with our team, and we can walk you through your particular tax situation. Or you can give us a call, 800-674-9050. Leave a message. We'll get back to you. All right. So let's go ahead and see if there's any questions here, and then we'll hop off on this live stream. So I see a question here that says, does it cost $20K for a Type 1A license? I'm not specifically sure what a Type 1A license is for your state. Let me just look up really quick for California if they're calling in. Type 1A CA Cannabis. We'll just see real quick what that is. So cultivation. I think in the city of LA, at least, they are doing, I think it's a $20,000 licensing fee per license. So John, yes, these licensing fees are very, very, very high. Rhode Island, I think, is $500,000 a year for their retail license fee. So it's very, very expensive to be in a regulated industry. Cannabis as a regulated industry, is no more prohibitively expensive than jumping into the like an airline industry or any other regulated industry. There are going to be other taxes associated with this cannabis industry that are not associated with the aviation or with other industries, pharmaceuticals and things of that nature. But the costs are incredibly high. So there are other states like Oklahoma that you can move to or partner with somebody in that state, and you get started for maybe 30% of the budget that you would in another state. So there are other options. And if you're really as passionate, not you specifically, John, but if anybody that wants to get into the industry says they'll do anything to get into the industry, then move. Leave the state that's holding you back and go to another state that allows you to, start your business at a cheaper rate. Make mega sacrifices for long-term generational wealth and generational success. If you're going to have an excuse, there's always a remedy to it. It's just how much do you want to sacrifice for your business or for what you think this could turn out to be? So hopefully that answered your question, John. Again, if you guys have any questions about cannabis businesses, taxes, please reach out to us via our website at greengrowcpas.com or give us a call at 800-674-9050. Have a great day. Thank you very much for your time, and we'll talk to you soon.